Mutual funds versus ETFs, a battle royale.
It's Brian Preston, the money guy.
Yeah, Brian, I think it's so funny. A lot of people look at it that way, right? They think about mutual funds versus ETFs. Which one's better? Which one's worse? Should I be doing this? Should I be doing that? And it seems like that's the common theme out there in the investment world. And I'm not so sure that we agree with that. I don't know that I think that is this controversial thing between the two.
It is fun to put things against each other. You see it with nightly news. You put one talking head that thinks this way, another talking head thinks this way. Let them go at it. You know, those things happen all the time, but we like to think that there's consensus here where you could use both of these as tools in your journey towards financial independence. But it is worthwhile. The creator, the founder of Vanguard and the original index fund, Jack Bogle, did have some unique things to say about ETFs. So kind of share, let's set the table and share what Jack thought.
Yeah, this is what Jack said. I think this was around 2007-ish. He said, during the past decade, the principles of the traditional index fund have been challenged by a sort of wolf in sheep's clothing, the exchange-traded fund. But let me be clear, there is nothing wrong with investing in those indexed ETFs that track the broad stock market, just so long as you don't trade them.
So that's such a unique statement, because when I hear sheep's and wolf's clothing, that's a negative thing. That's like saying somebody
did. I hear a wolf in sheep's clothing. I was like, why is a sheep dressed like a wolf?
When a wolf in sheep's clothing, let's get it right, because it does have two different things. Why would we'll just keep going. But it is kind of funny in the fact that if you think about it, that has negative connotations.
It does have a negative connotation.
That you are a wolf that is looking to sneak in, take advantage of the situation. And that's not what, if you really understand how ETFs can be an effective tool, it doesn't have to work that way. But I do think we should pay some respect to what Jack was implying, is that ETFs do have some unique opportunities, meaning like they trade intraday.
Yep.
And I think just because you can doesn't mean you should. And Jack is just cautioning you to be careful, because one of the biggest components of investing in mutual funds is it kind of locks in your behavior. You buy and hold, think long-term, and you're rewarded for that. So be careful when you add these new fancy, snazzy features that they don't distract your behavior and how you handle them.
So we thought one of the things that might be valuable is if we kind of look at mutual funds and ETFs. What are the pros? What are the cons? What are the valuable things? What are the not so valuable things? And how can you use them to ultimately improve your financial life? So let's jump right in with mutual funds. And in true Webster fashion, I think one of the things we like to do in the Money Guy show is whenever there's a financial term, we like to clearly define it. So what is a mutual fund? A mutual fund is an investment fund that allows you to pool your money together with other investors to purchase a collection of stocks, bonds, or other securities.
Here's something. We had FTE Daniel pull some cool facts. I was shocked to find out, and this is from the 2019 ICI study, is that still the lion's share of mutual funds are actively managed.
Yeah, there's sort of two thoughts there, right? There's actively managed mutual funds, and there's kind of what Jack Bogle was a proponent of, is passively managed index type funds.
But according to the research that Daniel pulled, only 29% of all mutual fund assets are in index equity mutual funds. So that means the lion's share are still in actively managed funds, which was kind of surprising. And if you need proof, here's some data points on this. Is that actively managed domestic equity mutual funds experienced a net outflow of $1.4 trillion from 2009 to 2018.
So it's changing. It sounds like the tides are shifting a little bit,
You think about it, but listen to this, because that was active managed. Before we say mutual funds are losing tons of assets, because then if you combine index mutual funds and ETFs, more to come on that, they received $1.6 trillion in assets. So it just shows that there is a shift going on of going from really active management to more passive index type investing. But it does show, because you notice they combined index mutual funds and ETFs. So we probably should explain what is an ETF.
Yeah, so again, in true Webster's dictionary fashion, what is an ETF? An ETF is an investment fund traded on a stock exchange similar to a stock. Unlike mutual funds, though, ETFs can be bought and sold throughout the course of the day.
And we'll talk about the behavioral side of that. I do think it's interesting when you look at the trends and what's going on with mutual funds, ETFs. But I think a lot of commission guys, a lot of fee-based guys, not the fee-only. I think fee-only guys, since we get paid directly by clients, we've never had a problem
been a
with, because since
it.
our clients are paying us directly for managing the funds, we always have been, for years, like people, when I did the index show, they're like, when did the money guy team become index proponents? I'm like, guys, we've been doing index funds for decades, so this is nothing new. But it isn't. The point made by some of the YouTube comments is that most financial advisors have been in a quandary when we talk about index funds, because you know where index funds typically are? They're no load, meaning there's no commission. So if you go to, think about some of the biggest, guys that are in your grocery store, in your shopping centers, the ones knocking on your doors trying to get you to buy investments. I'm not going to say their names, but you know who I'm referring to. They don't have index funds in their basket of tools.
Nope.
ETFs have come along, and you have seen quite a few fee-based type advisors that are using ETFs to kind of scratch that itch, check the box on buying into index type of products. And here's the proof on this. In 2011, 10% of assets under fee-based advisors were ETFs. And by 2017, that number's increased to 28%.
So from 10% to 28% from 2011 to 2017.
And then for full service brokers, these are your commission guys, they had 6% of assets in ETFs in 2011, and now that number's increased to 17% at the end of 2017.
So it sounds like, if I'm hearing you right, Brian, as ETFs have continued to advance and continue to progress, more and more investors of all shapes and sizes, brokers, individual investors, financial advisors, a lot of folks are using exchange-traded funds more so than they were 5-10 years ago.
Well, and I think it just ties into the trend. Index investing is here to stay. Passive management is here to stay, and we'll be talking about that. I did think it was one other data point before we move to the pros and cons of each of these type of investments. ETF owners, more aggressive in nature. Here's the research on that. 51% of ETF owning households are willing to take above average risk or substantial risk. Only 35% of mutual fund owning households are willing to do the same. That's also from the 2019 ICI research fact book that came out recently.
When I hear that, that kind of makes sense to me, because we know, you've already alluded to this, one of the things that's interesting about ETFs is you can trade them throughout the day. You can buy them and sell them pretty quickly.
Yeah.
Mutual funds tend to be a little bit slower, a little bit more boring. You put in your order today and it fills at the end of the day. You put your order in to sell, it sells at the... So it makes sense that someone who wants to be more active, more involved, do more, they would probably tend to lean towards ETFs as opposed to mutual funds.
That's a good way of looking at it. I think about that. So let's kind of talk about, I want to transition and talk about the pros and cons of mutual funds, because we are going to find there are some slight differences and things that you can capitalize off of with each of these investment products, or these vehicles. So first, let's talk about the pros of mutual funds. Number one, mutual funds can provide a diversified mix of stocks and bonds and are also not as risky as single stocks.
So a lot of folks, when they think about investing, they think, oh, I want to go out and buy Home Depot or Apple or Google or Tesla, or fill in the blank of the company you want to buy. Well, you hear us talk all the time and hear other financial folks talk about diversification. One of the big things you want to do is spread your assets out across a number of different companies. Well, if you were to try to do that on your own, it's a pretty daunting task. Imagine if you wanted to have S&P 500 exposure and you had to go out and buy 500 individual stocks. It'd be pretty hard.
Logistically, that'd be a mess.
Mutual funds make it much, much easier to do that by buying just one single fund to get that kind of diversified exposure.
What else do mutual funds do? Give us some more pros, bro.
Yeah, so the other thing that you can do is there is a large variety of funds. So it allows you to access different parts of the financial markets. You can have international mutual funds, large mutual funds, small mutual funds, hedged equity mutual funds. Pretty much, if you can think of it, there's a mutual fund that can satisfy that itch that you need to scratch in your investment portfolio.
I mean, even obscure stuff. I mean, see people, cannabis is a big thing. People are like, are there cannabis mutual funds? There are mutual funds for anything. Absolutely. So that's why it's really kind of interesting to look at these things. Keep it going.
So the next one is you don't need to invest in certain increments with mutual funds. So a lot of funds will have it where you can buy $10, $20, $30, $40, $50. You can actually buy based on the dollar value. You don't have to buy based on share value, which is kind of unique. We'll talk in a second about ETFs, how that's a little bit different. Mutual funds allow you to buy in customized increments and possibly even on customized timetables.
So it's probably easier. Well, I remember I had my high school moment where my economics teacher said, if you guys would invest $100 a month, you'll be a millionaire by the time you retire.
Yep.
It's probably... If you say $100, I want to do $100 a month, mutual funds is probably the thing
Probably
you need to be
gonna be the
looking
way to
at.
do it.
That's very easy because you can buy in those easy increments.
And that's a perfect segue. Mutual funds allow for automatic investing. So if you're someone who listens to the show and you think, man, I like this dollar cost averaging thing. I want to have my $100 a month go in and buy XYZ mutual fund so I can be a millionaire. Mutual funds are a really easy way to do that because you can just set it and forget it and let it keep rolling. And then, Brian, I think the last one, this is the one that you talk about all the time. Mutual funds provide great access to really low-cost indexed options.
Oh, that's great. There's also a lot of tax benefits. We'll get into that in a minute as well. But that's a great list of pros. Let's look at the ugly side of it. What's the cons of mutual funds?
So some do have minimum investments. You might need an initial investment of a couple of $1,000s to be able to access certain types of mutual funds.
Now, there's a price war that's been going on between Vanguard, Fidelity, and Charles Schwab. I mean, you've seen because TD Ameritrade is merged up into Schwab now. You've seen some victims of this battle that's been going on. I'm sure the numbers are much different now. I do think it's interesting. Like Fidelity, they have zero funds, meaning they have zero minimums. But I do know for years that like if you wanted to buy Vanguard, there was like a $2,500 minimum or other things. I think those numbers have come way down because there's this price war going on between Fidelity and Vanguard. But in the past, that was definitely, especially when people called and they said, hey, I want to open up an investment for my kids. I have $500. That threshold, I will tell you, this con is quickly going away though, because now you can open up custodial Roth IRAs. You can do all kind of custodial type things, minimum to zero fees with like Fidelity, Vanguard. There's a lot of good innovation that's going on that's taking away this con.
Yeah, it's just, the theme you're going to hear over and over is that technology has really changed it. It's made a lot of the pros of these investment types better and a lot of the cons slowly going away. Yep. The next con is that generally speaking, now not in every single circumstance, but generally speaking, mutual funds are not as tax efficient as exchange traded funds.
Yeah. Anybody who started, I want to go ahead and tell you, if you weren't paying attention to the Money Guy show and you invested in a mutual fund in the fourth quarter of 2019, you probably were shocked when you got your 1099 at the end of the year and you're like, what is this?
What the heck is this
distribution I got and all this taxable income that this fund, because it was not uncommon to have mutual funds that had 15 to 20% of their net asset value, meaning being distributed out as income to the shareholders. You're probably like, wow, I'm getting a quick education on these things can be tax inefficient. I need to be careful.
And then the next one is that mutual funds, depending on what fund family or fund company you're buying from, they may have trading fees. So a lot of funds, in order for you to access that fund or that fund family, you might have to pay $25, $45, $75 just to access that fund. So there could possibly be some fees there. Now, even that, Brian, is changing where a lot of funds now offer no-load funds or non-transaction fee funds where you can get into without having to pay that, but they still do exist.
Well, but tell me if I'm wrong on this, because I don't do the actual trading for clients every day. Fidelity, if you're buying a Vanguard fund, there is a ticket charge on that.
That's right.
That's actually been increasing. I would say that instead of that going away, I've seen that increase. There used to be more NTF fees, I feel like. But then what's weird is we're about to cover exchange trade funds. There's been a price battle to get those down to zero as much as possible. So it's just so interesting to see the pros and cons list and the evolution of what's going on behind the scenes with these price wars.
That's exactly right. And then the one thing, and we'll talk about this in a second, but it's kind of, we were trying to figure out, does it fit into the pro column or does it fit into the con column? And we couldn't decide. So we kind of thought it was right in the middle, is that mutual funds do trade once a day at the end of the day. What they do is they look at the underlying value of all the holdings. They determine the net asset value of all the holdings that fund holds. And whatever that price is, that's what you get to buy or get to sell at. So whether you put your order in at 8:30 in the morning or 2:30 in the afternoon, you're going to buy or sell at the same price as all the other investors.
If you're a person that wants control, that could be a negative thing.
Sure.
Especially because I had a call, I had a brand new client. We were dollar cost averaging in. I think it was so interesting to me because he finally caught on the third month he was investing with me, because he was calling, because I was like, today's the dollar cost averaging day. And he would call me on those days and be like, oh, I don't know. The market opened up down 0.5% today. maybe we should hold off. And it was only after the third month that he realized mutual funds trade at the end of the day. And I had to explain, I was like, yeah, it doesn't matter what's going on intraday with these. So it could be a positive thing, or if you're one of these very control people and you want to take advantage of the fluctuation throughout the day, it might be a negative for you. So it is a kind of in the gray column. That's why we had FTE Daniel put it right in between.
Love it. Okay, so let's shift a little bit and talk about pros and cons of ETFs, or exchange traded funds, right? The very first one, exact same pro as mutual funds, same thing is true of ETFs. You get diversification, reduced risk. Generally, if you can spread your assets across a bunch of different companies or holdings or underlying securities, you can reduce the overall risk. ETFs provide a very easy, simple way to get that sort of access.
Yep. I have nothing to add on that one, so you can keep it rolling.
I love it. The next one is they also have a huge variety of funds. Just like if you want to invest in companies that specialize in hair treatment, you can go find your hair treatment ETF. I made that one up. But they can be very, very specialized, and it's a large variety of funds out there.
The reason I think it's kind of funny because I feel like I just kind of was like, yep, keep it rolling. These are so similar to mutual funds that these kind of seem like, did they accidentally put the same slide up again? No, it's just that mutual funds and ETFs are very similar in some of these benefits. So that's why I think it's okay if we keep rocking and rolling through this.
Love it. The next one is that generally speaking, there are no investment minimums with ETFs other than the share price, right? So generally you have to buy whole shares when you buy in ETFs. So long as you have enough to buy one share, you should be covered. They don't have a $100, $1,000, $2,500 minimum to get into them. And just like mutual funds, ETFs offer you access to very low cost index funds. You can go just buy the set it and forget it index, same as you can with mutual funds. And so just like this was a con for the mutual funds, this is actually a pro of ETFs. Generally speaking, they tend to be more tax efficient than their mutual fund brethren.
Yeah, we'll talk about that in a minute when we get to unique planning opportunities. It is one of those things, you don't have embedded gains and losses with ETFs like you do with mutual funds. So that creates a unique planning thing. I will tell you, it could be good, it could be bad, but it is nice that they are very tax efficient and you're not buying into the embedded gains of somebody else's portfolio.
Exactly right. Okay, so now let's look at some of the cons. So here's the first one. You can't automatically invest into ETFs every month. Now that is actually also changing too, because now some custodians are allowing fractional trading and they will allow you to do that. But most custodians still have a hard time. If you want to go buy $100 a month or $500 a month, they're probably going to want you to do that in a mutual fund versus in an ETF. It's just not as easy because they have to make the decision for you. Does it buy at the beginning of the day or the end of the day or the middle of the day? Because of that, they generally won't allow you to do that. And some do also have trading fees if you want to buy a mutual fund. Now, again, and I feel like we keep giving like disclosures on every single one of these.
Everything's changing. I mean, the system, when you watch this show in 3 years from now, it could be a little different. Because this is about? Well, I mean, because it is. It's constantly changing. It's just like, I will tell you, traditionally, historically, if you're buying monthly, you want to be buying a mutual fund because of exactly the automatically investing in ETFs with the pricing structure. It's weird on when it's buying. That could have trading fees, but Bo nailed it. These things are evolving, and I do worry 3 to 4 years from now, this could be a different. The con could be completely, you could commingle the ETFs and mutual funds even more because of what technology is doing to them.
Now, the other thing that is a little unique to ETFs relative to mutual funds is that there could be liquidity issues with smaller ETFs. It depends on the volume of that ETF that trades. I already know why you're laughing.
Well, look, and we'll bring it up later, but we had a 40-minute sidebar discussion when we were doing pre-show meeting on this is because, and Rebe, I felt so bad because we're all financial nerds here.
She's not a financial nerd. When we started talking about
the premium versus discount of ETF pricing, I could see the glaze, so we'll pause it there. Just keep going. We'll just keep it going.
So then, okay, as you can probably guess, there is some middle ground. And here's what we think the big middle ground is with the pro and con of ETFs is that there is intraday pricing. So unlike mutual funds that only trade once a day at the end of the day, ETFs trade just like a stock. Throughout the course of the day, you can buy and sell and buy and sell. However, it might not always be a good thing.
Yeah, we kind of went over that on when it's positive or negative. It depends on how much control you want. And sometimes that ability to trade intraday could actually be your enemy. And we'll go over that in a little bit as well as we get into unique planning opportunities. But let's talk about the expenses, because I think that is something we all are curious about. Daniel went and pulled the annual research. I pay attention every year to see what the trends are. Realize when I started managing money in the 90s, the average internal expense for a mutual fund was over 1.5%.
Even today, that just sounds insane to think about paying over 1.5% per year internally on a single fund.
And then a lot of them had loads on the front end. You could buy, A shares, B shares. And think about this. If you were buying a B or C share, it wasn't uncommon for the internal expenses to be pushed up to 2% or really close to 2% or even over. There was a lot of B shares because realize B shares were trying to look like index funds in the fact that there was no load funds because they had no commission on the front end. But the internal expenses, it was not uncommon for the internal expenses to be around 2.5%. And then if you sold them, it was a declining. It was like 5% the first year, 4% the second year, 3%. It was a step down process. These things were horrific. Thank goodness innovation, just competition has created much better products for the investment landscape. There's no better time to invest in right now.
That's exactly right. And so one of the things we wanted to look at is, and we get asked this all the time from folks, okay, well, which one is cheaper, right? You hear both, low cost and low cost. Well, which one's really the most low cost? Which one is really the cheapest investment to buy?
So we had FTE Daniel go pull together the data points. And here's what we found. And by the way, you guys pick on us so much about the use of average. We use median. So take the median, and you can see all funds. I do think this is interesting. When we look at mutual funds, like I said, the average was over 1.5% when I started managing money in the 90s. Now it's 0.88%. ETFs, you look at that and you go, wow, 0.5%. That's even cheaper than the mutual funds. But then I think it is kind of interesting when you look at, we told you the lion's share of mutual funds is still actively managed. And you can see there's a lot of people that are paying for managers. I would question, are they really getting any alpha for that? But they're paying close to 1% on the equity. They're paying 0.66 on the bonds. ETFs are substantially cheaper. But this is such a unique thing. And then you look at the indexed equity funds. These are just mutual funds and ETFs that are buying into the indices. And you can see mutual funds, the median is 0.33 versus ETF is at 0.47. But guys, here's what these numbers don't show. You might make this and you look at this and go, I'm going to just determine that if I'm buying indexes, I ought to just buy mutual funds because according to this chart, they're cheaper. You need to do more research in that, because here's what I mean by that is that if you look at SPY.
Okay, yeah, the S&P 500 ETF.
It's 0.09%, 0.095%, I believe. So for every $1,000 you invest, it's like 95 cents. That's practically free, by the way, guys.
That's very practically free.
Cheap. But then what's the other one which you see us use? It's also an S&P 500.
IVV, iShares S&P 500 ETF.
That one is 0.04%.
Something around
so
there,
it's 4 cents for every $1,000. But then I'm going to blow your mind because you go look at the Fidelity S&P 500 fund, and it's 0.015.
Yep.
So it's 15 cents for every $1,000. You see these averages up here where it's 0.33 or 0.47, depending on if you're looking at mutual funds versus ETFs. But if you just do a little due diligence, you can see there are funds that are actually practically free. And then Fidelity actually has zero funds, which have, which you can do total market funds, other things. They can't call it a Standard & Poor's S&P 500 because then they have to pay some fees for that. But they have something like large U.S. companies, which is very similar to the S&P 500, which is free.
So if I'm hearing you say this, when it comes to like designing your portfolio and picking which investment options, which investment types you're going to use, it's probably not going to be all ETFs or all mutual funds if you're going based solely on expenses, because sometimes the ETFs are more inexpensive and sometimes the mutual funds are more inexpensive. You really kind of need to do your research to understand what fits your portfolio best. Is that what I'm hearing you say?
For sure, exactly. But that does lead to the next question, is you're asking yourself, well, if it's so much cheaper to do these passive strategies, active versus passive, when does where does this all come into play with active versus passive? And by the way, it used to be that active was only on the mutual fund, but we've started to see, this is why these things are so commingled. You're starting to see ETFs that now have some managed component or smart alpha.
Yep.
So they have some way component which when you see alpha or smart beta, that means a manager's not
making
just buying
some sort of
they're
decision.
not making the indice. They're not just buying the indice for what it is. They're trying to make some determination of why this is good or bad. So it's like management is coming into play. So we wanted to kind of talk about this. So when you talk about active versus passive, it is interesting when you look at SPIVA data. I mean, it's crazy. Was it like 88% of they can't? The index beats 88% of the managers over anything greater than 5 years on the large cap side. When you start thinking about that, that means 8 to 9 of the 10 funds are going to underperform the index fund.
Right.
You have to ask yourself, what's going on? What am I actually getting value from these active managers? So give them kind of the abound thoughts on active versus passive, Bo.
Yeah, so what we love is that where we can index, where we can buy super low cost, don't have to think about it, not beat the market, just be the market funds, we like to do that. So like, U.S. large cap is a great example. We think just buying the low cost, practically free index makes a lot of sense. But perhaps there are some asset classes that are a little bit more unique. You can think about even right now in a very low interest rate environment where some people think rates are going to go up and some people think rates are going to go down and some people think you ought to be on the short end and some people think you ought to be on the long end of the curve. And we have a lot of quantitative easing. We have a lot of government paper being printed. Maybe you don't want to be in like a fixed income index. Perhaps active managers could be better positioned to navigate that environment well. You could say the same sort of thing in the real estate market. Perhaps with the way that e-commerce is changing real estate, perhaps active management inside real estate makes more sense than passive management. The point that we're making is when it comes to portfolio construction and design, we're not so dogmatic that it's all one or all the other. But in the places where we do choose to go active, we have a reason for doing that. And that reason usually is not because we want to beat the market. It's not because we think we have some prowess that we can do that. It's because something is taking place macroeconomically that causes us to want to shift assets in that direction.
Well, distortions. That's what it's just like when you mentioned quantitative easing.
Yep.
If you go look at index funds in the bond sector, once we continue watching the government go back to pumping so much money out there, you're going to notice it's all the indexes are going to be all governmental indexes. It's not going to have a lot of diversification. You also talk about distortions. Talk about real estate. If everybody's now doing Amazon, and we see all these malls sitting out there and traditional big box retailers, that's going to create some weird distortions in the retail sector. So you need to pay attention to those things. But you do need to make sure that if you are paying for an active manager, they better be performing. And they better be even overcoming the tax limitations. Because realize index funds, since they don't trade so much, they're much more tax efficient, meaning your year-end distributions are substantially lower. You just want to make sure that you're doing a lot of research, a lot of due diligence, because a lot of times, whether you're talking about international, whether you're talking about domestically, the index funds do incredibly well, and they take a lot of the guesswork. They lower fees. There's not that headwind. It's a good thing to look at the index funds in a lot of ways if you can go the cheaper route.
So I want to repeat what I just heard you say, Brian. When it comes to like active and passive, it's not either or. It's potentially both and, depending on the circumstance. Wouldn't you say the same thing could be said for mutual funds versus ETFs? It's not either or, it's most likely a both and, depending on your individual circumstance and what you're trying to accomplish.
And we've talked about, I love index target retirement funds for those under $500,000 because it lets you focus on the savings and lets them focus on the asset allocation because they go from aggressive to more conservative as you go through the years. But it's like that with the individual investors. You are going to reach a level of success after $500,000. You'll need the additional attention. You'll need to go ahead and look at tax loss harvesting, tax location, all these things that come into play that it's just better to have a more custom route than just buying the all-in-one target retirement fund.
And so I think, Brian, that's a beautiful segue because as we were sitting down thinking about, okay, well, obviously the listeners are going to want to know, well, how do I decide when does a mutual fund make sense? When does an ETF make sense? Well, we said, let's think about some of the unique financial planning opportunities that we do for clients, sort of on a regular basis, or things we look at year to year, and kind of share some of those so that you guys can use that as you think about how you build and construct your portfolio.
So I want to jump right into these because I think the first one, when I'm thinking about unique planning opportunities, capital gains should come into play because when you talk about what is the tax impact of what's going on here, capital gains, like if we have somebody who's brand new client, they come to us in fourth quarter, if you go buy a just portfolio full of mutual funds, you have to be careful because there might be some embedded capital gains that are going to be distributed out that you don't want your client signing up, going and investing in a portfolio, and then getting a big tax bill at the end of the year when they've only been participating for a short period of time.
This is a common misnomer that I hear all the time. Someone will say, hey, Bo, I saw this fund, and if I hold this fund on December 5th, they're going to issue a 14% capital gain distribution. Doesn't that mean I'm going to get a 14% rate of return if I own it on that day? No, all you get is the tax bill. It's actually a net neutral zero event. They decrease the value of your holding, and you just get to pay the taxes on it. So if you can avoid those large distributions of mutual funds at the end of the year, it likely makes sense to do so.
So just to make sure you all heard him, they adjust the price that mutual funds trade at for those distributions. So don't get excited thinking, hey, I'm going to go buy this fund the day before they record the investors of record, and then I'm going to make 14% just because I bought in. No, they'll lower the price of your investments. Yes, you will still. That's why it ends up being a neutral event, but you are going to pay the taxes on that income. So pay attention to that. But look, it cuts the other way. We just came through a bear market. There's a chance if you went on Morningstar and looked at values as of 3/31, there might be a group of mutual funds out there that are trading at a discount, meaning that if you look at are there embedded losses that are within their portfolios, that means you could buy into a mutual fund and maybe it could make 10 to 15% before it gets back to break even, where you're going to have 10 to 15% of gains before distributions might even come into play.
They've actually done, this isn't really what they did, but they kind of did some loss harvesting for you. We did a ton of this in 2009 at the beginning of the year. We'd actually go screen our mutual funds, and if there was a 30 or 40% embedded loss, and we felt like that fund was positioned well to perform well moving forward, we'd absolutely go grab that. Then we kind of had a tax-free ride for that first 20 or 30%.
That planning opportunity only works coming out of down markets. Now realize, markets typically make money 8 out of 10 years. So more than likely you have an embedded gain in your mutual fund, not an embedded loss.
That's right.
But there are some unique times, twice every decade usually, we just came out of one, that there might be some embedded losses. And in those situations, a mutual fund with an embedded loss is better than an ETF because every dollar you make from the day you invest with the ETF, you're going to pay taxes as it gains. If you have an embedded loss on the mutual fund, you might have a head start before you have to start paying the tax man. So pay attention to that. And then, those are some of the big things that are going on. But let's talk about the intraday pricing.
Yeah, so one of the things that is a benefit is you have some hands-on control over the price that you trade, right? So, again, we just came through this COVID-19 thing, and there were days where the market would open up down 6 or 7%, and the client would come back, hey, the market's down, let's buy. Well, if we actually behaved in that way, if we put in a mutual fund trade, we wouldn't actually be capitalizing on that because a mutual fund doesn't trade until the end of the day. If you wanted to capitalize on the market being down in the morning, you'd have to buy an ETF to do that. Well, intraday pricing allows you to have a little more control over the timing of the trades that you're placing.
Now, I'm going to sound a little bit, maybe it's because I'm getting older, I'm more like Jack Bogle, is I think that those price fluctuations throughout the day tend to push you more towards the speculative side of investing versus the fundamental side. And this is the part, I alluded to it earlier. We went on a 40-minute, I had 2 slides built into this presentation explaining the distortions of mid to late March with bonds, bond ETFs specifically. The team made me throw out these slides because they were worried you guys were going to go to sleep. So I'm just going to try to do a really good job of summarizing this. March 18th, 19th, 20th. You probably could throw in the 20th. There was a lot of crazy things going on in the equity marketplace that was bleeding over into the bond ETF marketplace. So what we saw was we saw if you were buying a bond ETF of like the AGG, the price fluctuation throughout the day could have been as high as 4 to 4.5%.
In one single day of trading, the price moved that much on a bond ETF.
And then think about day two, because put 2 days together, another 4 to 5% fluctuation. If you were the worst investor or unluckiest investor, you potentially could have a 10% fluctuation on your risk-off bond fund when really the bond fund traded in less than a 1% trading band if you were buying the mutual fund.
So inherently, if you are trading ETFs, because of those price distortions, even taking away from just generally the asset class you're investing in, you are naturally adding risk to your portfolio just because of how much those prices can fluctuate intraday.
Now, fortunately, this is the second slide that y'all made me take away. The lion's share of the time, 90% of the time, ETFs trade within the ending value of the NAV value of their brethren that are mutual funds. So it's not this is only in unique, distorted times. I'm just saying that if you're an investor and you're looking at your investments from what's risk on, like equities, risk off, like cash and bonds or fixed income, you might need to think about that extra level of risk or volatility, because you might be counting on this money to be super safe, but then you find out it's got 4 to 5% price fluctuations just because of the intraday pricing. That's just something you ought to take into account, because it is exactly what Bo said. It pushes it further out on the risk spectrum than what you might have been anticipating when you bought the product.
That's exactly right.
Was that better than the 2 slides?
That was so much better than the 2 slides.
Reby, do you agree?
That was so much better.
How did we talk about that for 40 minutes before poor Daniel adding changing slides? We'll keep it going. But that probably did sound better than the 2 slides I had.
The next planning opportunity. Here's the planning opportunity from that. Just because you can trade intraday, you probably shouldn't do a lot of intraday trades when there's wild volatility, especially inside of ETFs, because potentially what you're trading, you're getting more than you bargained for. I just put a nice little bow on that. All right, so let's talk about the third one, loss harvesting.
And this isn't necessarily, now tell me, you might disagree with me. I don't think this is a ETFs versus a mutual fund. I think this is just a tactic that you can use, but loss harvesting is something, let me say, first of all, definition.
Okay.
Loss harvesting, all that means is within your taxable accounts, not your retirement accounts, but your taxable accounts, if you have a loss, you can lock it in and turn that loss to where it becomes a paper loss that you actually take a tax deduction for or offset gains in the future. Now here's where I think why we put this in here. ETFs get some special treatment in the fact that it's much easier. Like you could sell the SPY and then go buy the total bond, another ETF or total stock market index fund. And you essentially, even though you sold the S&P 500 ETF, it's enough difference there that you could probably lock in the loss.
Yeah, one of the strategies that we were able to employ in the first quarter of this year is that the market fell so rapidly, so quickly. Normally we're able to loss harvest, maybe one time a year in down years. Well, what it allowed us to do is we could have an index-esque fund and the market could drop and we could loss harvest and sell that fund and go buy a materially different fund but inside the same asset class. Well, then the market would fall further inside of 30 days. So we couldn't go buy the original fund. We had to have a stable. What ETFs have allowed us to do is build a stable of similar but materially different ETFs that we can loss harvest across. With mutual funds, at least in our experience, it's been a harder thing to do. ETFs might allow you to do that. Now, here's what you really want to do. Have a stable of both, and then you can kind of control what exposure you're doing. That's how you end up having a very tax-efficient portfolio long-term.
Now, a lot of people, because I've had a few people question us when we've done episodes on loss harvesting, they'll be like, but don't you end up in the same place? I mean, if you're selling $1,000 turns into $5, now look, I'm using super low. Maybe I should use a bigger number. Let's do $100,000 goes down to $50,000, but then back up to $100,000. If you did absolutely nothing, your $100,000 still is $100,000, went down, went up. The difference with a loss harvest is you go down to 50, you lock in the $50,000 loss, you buy another equity type investment that's different enough that you can take the paper loss, it goes back up to 100. Yes, now you have an embedded gain of 50,000, but you have a paper loss of 50,000. You are in the same place. Here's the difference. You're holding for years. So when you file your taxes in April, you're going to be able to actually turn a portion of that loss into a tax deduction that will lower your taxes.
Absolutely.
The guy who did absolutely nothing, not going to be able to turn that into it. The other thing is, if you're charitably minded, if you sold low and now you reinvested and now you've got this essentially 100% gain on the purchase when you bought when it was low, if you gift that to a charity or donate it to a charitable gift fund, you get the max deduction for the market value. It's just a great planning opportunity. That's why we're talking about unique planning things you can do that's a little more sophisticated, but definitely takes advantage of it. And ETFs do give you some additional tools there. Let's pivot now to, because I don't want to just pick on my mutual fund friends. You know, we need to say mutual funds have a place too. How about automatic dollar cost averaging?
Yeah, this is the one. We've already kind of alluded to this. If you are someone who wants to set up an automatic dollar cost averaging plan where every month I want to have $100, $250, $500, fill in the blank, and you want to just have that going, you don't think about it, you don't look at it, you just have it automatically purchase. Mutual funds are going to be the best way to do that. It's much more difficult to do that with ETFs. In my experience, I've had folks say, no, I only want to invest in ETFs. I'll just set a teaser that every month on the 10th, I'll just go in and buy $100 that ETF. Yeah, that's easy to say until the day that you go in to buy, maybe the market's down really, really bad. And you're like, oh, I don't know about that, when you should be excited. Or worse, what if the market's up a lot that day? By using mutual funds, you remove some of that emotion where you don't have to think about it. You don't have to figure out when to buy, when not to buy. You just set it and let it automatically start working. That's one of the reasons we love. Whenever we set up automatic DCA plans, we do it in mutual funds, so you don't even have to worry about it.
So we got kind of fancy with some of our retirement plans, put some ETFs in there. Then a lot of the 401k providers came back and said,
we're not doing that.
We're not doing this. Mutual funds are so much easier because of all the things we just talked about with automatic, systematic savings plans. Mutual funds are just easier.
That's right.
So that's why, think about that when we were talking about the pros and cons, but it is one of those things that I think definitely leans more towards a mutual fund. All these things, I know we started this talking about the conflict. We had even Jack Bogle talking about wolves in sheep's clothing. I wanted to make sure I got that right. Wolf in sheep's clothing.
Wolf in sheep's clothing.
You know, that's the way he described ETFs, because they were kind of getting into the territory of his sacred index funds and index investing. But I think as we've shared in today's show, there's actually a place for both. You just need to know what each one does well, what each one has limitations in, and then make sure you're just marrying the perfect combination for what your financial situation needs.
That's exactly right. We think they're just two different tools in your tool belt that can make sense in different situations.
When you say tool belt, it makes me think that I could have worn my Batman shirt and you could have worn the Robin shirt again, and it could have been we could have done Batman and the Boy Wonder.
You know what? I'll at least take like Tim the Toolman Taylor and Al Borland. I would even take that one. Hey, speaking of tools,
greatest thing I've ever done is make us do the Batman and Robin show.
Yeah, I love it
because it just is the joke that keeps on giving.
Hey, if you haven't seen that show, you should go check out Money Guy Superhero Show because that was fun. But speaking of tools in your tool belt, in your financial tool belt, one of the great tools that you can use is the Money Guy team and the resources we make available to you guys. If you've not gone out to our website, moneyguy.com/resources, out there we have worksheets, templates, PDFs. It is all available for you to use. We just had a meeting this past week adding new deliverables. They're in process. We are in the Bat Cave or the Robin Cave, putting them together, getting them ready for you guys. So if you've not gone to check out the resource page, make sure that you do that. Give us your email address. That's the only way you're going to know when we put new stuff out there for you.
And guys, make sure you subscribe. Have the awesome, audacious goal of 100,000 by year end. I think Bo's starting to question it. I still have faith that you guys are going to get us to 100,000. So go subscribe on YouTube. Also ring the bell. And then don't forget, Bo just talked about the resource page. We need your email address. So when you go to the moneyguy.com website, give us your email address so we know who you are, so you can join the Money Guy family, and you will not regret the decision. We've been doing this since 2006. Plan on doing it for decades longer. Lots of resources. The abundance cycle explained is you come here, there's no catch, you learn from all the free advice, apply it to yourself, you will reach a level of success that you get so scared that, hey, this thing is so big I don't want to screw it up. It's so big that I need to make sure I'm maximizing all those unique custom opportunities. This is when I need to have a co-pilot. You're going to remember the guys that got you there, and that's the Abound Wealth crew. So that's the abundance cycle explained. So enjoy the free stuff, and thank you for supporting us. This is the Money Guy team, and we're out.